Welcome to Commercial Real Estate Now, in partnership with CBRE Econometric Advisors and my co-host Dan Diebel. I'm Carly Iacono. Dan, lovely to see you. How are you holding up? How's life?
Great to see you too. I am holding up, and that is life, and that's just fine for right now. Sometimes all we can do is hold up. But excited for today, excited to talk some more economics and retail.
That was very inspiring. I just want you to know it was a very uplifting way to kick off the podcast. No, I'm teasing. Good luck with the little kid, little
Yeah,
new one. I know it's tough. All good.
yeah. I spent some time in New Zealand when I was in high school. And New Zealanders are known for being very, very straightforward. Like when you ask them, "Oh, hey, how's it going?" They will tell you, and they'll just be like, "Oh, it's horrible. It is a horrible day today," or something like that. And
Right.
it was so jarring. And then like I came back to the United States, and people would be like, "Oh, how are you?" And I was like, "Man, it was a bad day today." Like, but I'm getting through it, and like just they
No
don't
one knows what
explain
to
it.
do.
Like everything has to be good all the time, and it's such a culture shock. Like coming back from New Zealand, and I took my wife and I honeymooned in New Zealand,
Oh,
uh,
amazing.
and she is very American, and like everything is great. Like
Right.
it's
Standard
good,
answer. Great.
great day. And it had a similar cultural effect on her. So that's all to say, we can still have fun, even if maybe the day isn't shaping up to be 100%. We're gonna still give it 100% from here on out.
Exactly. Okay. I love the realism. I think we all need a little dose of that. So thank you. Thank you for that. Today, we are talking about something very positive, and that is hidden gem markets for retail investing. I especially like this episode because we have so much chatter around Florida, Nashville, and all these hot places, which are still great, right? No negativity towards our favorite markets here, but there's so much more opportunity behind the headline markets. So, we wanted to take a few minutes today and spotlight 6 sort of hidden gem markets and help our listeners start framing the perspective that there are opportunities that maybe they weren't aware of. And hopefully, they can take these insights and apply it to some other hidden gem markets throughout the US. So, that's today's goal. Before we jump into what those 6 are, let's just kind of run through why they're hidden gems, why they're less obvious, or what makes them, kind of come into focus for future opportunity. What's one thing that you would point to when saying a market is a hidden gem?
Yeah. So this is a good question. Like, what makes a hidden gem? And it can be a lot of things. In retail, there's always an opportunity for opportunistic retail, all the way from opportunistic retail, you know, all the way through your core retail investment strategies. There are opportunities aplenty across the US in retail. But when we're looking at markets, we want to look somewhere where either vacancy is dropping, that means demand for space is growing. There's positive momentum in that market. That when retailers see a market doing well and they want to move into it, that's a good sign that spending and consumers and wallets are moving to that market. Now, that has been challenged recently because we're at historic low levels of vacancy. So
Right.
some of these markets that have seen decreasing vacancy have turned the corner. They're now seeing a little bump in vacancy, and they're also seeing rent growth, which doesn't normally happen.
Hmm.
So we're going to specifically look at some of the hidden gems that are still seeing demand momentum and rental growth momentum. Now, that's not to say these other markets that are not seeing both of those things are not great, right? A lot of the markets in the Sun Belt have bottomed out on vacancy, and
Right.
they've just kind of gotten stuck there. And now we're going to stay at that very low level and still see positive rental growth in these markets because consumer demand is high and supply is so low. But we're going to talk about some other markets to look at that we haven't talked about for the last 2 to 3 years feel like the last 2 to 3 years has been Sunbelt, 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 Sunbelt,
It has. You sure you don't want to say it one more time? I think
Sunbelt.
you keep. There you go. Okay, good.
Was
Yes,
that was is that
I think
the
that was
rule of threes for
probably enough.
comedy, right?
Right. Yeah. You just
Yep.
gotta hit that number correct for
Yeah.
effect. I think we did.
hmm
I think we did.
That's why it's a mad, 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 mad world was so groundbreaking because they had the fourth mad in there, which was extra mad instead of just like the three classical comedic mads. Anyway, a little bit of
Yeah,
film
it's
history.
exactly what I was thinking of. When we started this podcast. So thank you. Thank you for bringing that
We can
home.
put that in the show notes after the fact.
Love
Yeah.
it. So there's so many other factors, right? The effect of obsolescence, which we've talked about in previous episodes, the employment numbers, population shifts. There's a lot of different things that lead to, I guess, outsized opportunity for an investor in a market. And the ones that we're going to mention, I think are particularly interesting because they're not all the same exact story, right? They're kind of hidden gems for slightly different reasons, some of them. And that's what makes it interesting. So let's jump into our first one, which happens to be very close to me. Actually, several of these are, which is exciting. So, our first hidden gem market is Westchester, New York. And for those of you not in the New York metro, it is a lovely commuter area right outside New York City, good train access, very close to the Tappan Zee Bridge, like just a really well located area nearby to New York City. And you would have thought this would have always been a not so hidden gem, right? Really just in demand. The location's incredible. But that hasn't always been the case. It has shifted over time. And really, I think the last year has positioned it exceptionally well. So tell me what you love about Westchester, New York.
Yeah, it's a commuter market. So as you mentioned, it's a commuter market. You think that commuter markets are going to do relatively well with the return to work. They're just going to see more traffic back at those retailers that are located along these commuter routes, be them by car or metro. I know that if you're listening to this and you're in the West or out west of the United States, when you say traffic, you think physical driving traffic. But I feel like when you're on the East Coast and you say like traffic, it's like foot traffic because when you're commuting, you're normally taking a metro or something else in. You're probably avoiding
You're exactly right.
driving.
We say
Yeah,
traffic is a good thing, right? There's a lot of traffic around our retail, which means foot traffic, right?
yeah,
Thank you for that distinction. Hadn't
yeah.
looked at it that way,
So
but I think you're right.
all of these traffics are going to go up in Westchester as return to work kind of takes hold, especially in New York, where rents on these office buildings are really high, and companies are trying to get people back into the office more aggressively in some of these gateway cities, which means these areas located around these gateway cities and maybe secondary or tertiary even are going to start to do better as they see more movement and more activity happen around them in general. The Westchester also had some malls that kind of collapsed and have been since removed from retail. And whenever we remove that retail space, it just all the retail gets more and more concentrated in the successful areas. There have been a bunch of studies on this that all confirm the agglomeration effects of retail and locating close together and how that generally benefits all of the retailers. And Westchester is, it's sitting at a relatively low vacancy that has been stable. The rents are increasing slightly year over year. Some of this is due to some of the space left on the market not being some of the best space. So we are seeing those
Okay.
increases be slighter than we would have expected. Even though this is a market to watch, we do think it maintains demand momentum from retailers and it retains rental growth momentum above the average expected. Our average expected rental growth is about 2.1% through the end of the year. And for even our worst markets, our 29 markets that got a slight downgrade, which we won't talk about here, they're still going to see rental growth on average of 1.4% year over year, right? So all of the rental growth is always positive. Here we're saying we see more reason in these markets to see accelerating rental growth than we did before. And that's because of all the traffic that Westchester and other commuter markets will experience.
And I think the vacancy, you touched on this briefly, but I believe that the vacancy is sub 4% and
Mm-hmm.
stable year over year. Now, that could be to your point because some of the retail was obsolete and taken from the markets, or overall supply decreased as well. But that's below the national average for sure in terms of overall vacancy. So it sounds like you have a very tight market. You have increased foot traffic and car traffic, just traffic in general. You have demand from retailers all coming together to fuel rent growth. Makes sense. I think the last thing I would add, this is a very difficult area, as a lot of these are, to develop because land prices are very high. So there's not a lot of new supply coming on. And I think that's a theme we'll see probably in most of these markets. But how much of an effect do you think just the overall cost, the land basis, has on limiting supply?
Yeah, I mean, the more expensive the land, the more limited the supply. Because if you're going to build, you have to ensure a retailer can move in there. Your carrying costs are going to be higher. Your financing is all going to be more difficult to do. And finding a place, first of all, to build a new center when other centers around you have struggled and retail has continued to consolidate is there's risk in that will be priced in somewhere along in the formula,
Right.
uh, which makes it harder to build and harder to supply. We've seen most construction happens in new build areas around either new housing or just outside of like new housing developments.
So that's definitely going to be a factor with Westchester in particular,
Mhm.
just the challenge in developing, which will maintain the security of the existing retail product and be another factor that boosts rents. So lots of factors coming together nicely for Westchester. Good
Yeah.
news for everyone who's looking in the
Mhm.
New York region. Let's move on to the other side of the country. And this is a Texas market that you have likely heard of, and that is San Antonio. Not my home base, but very familiar. What do you like about San Antonio? How did it make our list of six?
Yeah. So, it's in the Sun Belt. I think that if this market is maybe not a hidden gem to some, but the amount of developers that are looking into this market and redevelopers that are looking into this market has continued to grow. And that's providing a lot of tailwinds for both rental growth and for occupancy. Now, even though there's a lot of interest, there's not a lot of build. Like when we're talking about new retail builds, it's still at an all-time low
Right.
compared to historical builds. So when I'm saying a lot of retail being built, we're still talking percentages of a percentage of the total space. It's
Wow.
not meaningful in terms of a total space in the market, but that's what's kind of nice about that San Antonio. It's sitting at like 95% occupancy, and
Right.
that allows you to build. And more retailers want to move there and expand there, especially given all the population growth that almost everywhere in Texas has seen um, recently and post pandemic, especially.
So again, the factors of population growth, maybe some migration, continued focus on the Sun Belt, and retailer demand. It sounds like those are the factors really contributing to the strength of this market. Developers just can't keep up with the retailer demand, right? Sounds
Mm,
like there's a lot who want to build and a lot of retailers who want to open, but getting those projects done are still challenging, which is
yeah,
good for investors.
great. Yeah, great for investors. I keep every time I talk to retailers, I'm like, have you guys given any thought to dipping your toe into, building your own spaces? And I had a great conversation with a quick service retailer the other day, and that's actually part of their strategy. Part
Hmm.
of their strategy is to go into these markets, and they'll buy the pad, or they'll attempt to buy out the real estate and then either build or rebuild it to their specifications because of all the tax advantages that they can get, and they can put it in a trust, and then they can, depreciate it from the company and all these other things. And it's a large QSR company, like they're national. uh, that strategy, I'm surprised some of these larger retailers have not taken on, because they've done it in the past, and right now it would seem to be the time to buy. It looks like we've got, uh, interest rate cuts possibly on the horizon, which means you're going to see valuations start to increase in the near future. The lack of supply should prop up that NOI growth, which means markets like San Antonio that have a really high occupancy can continue to draw retailer spending and rental growth.
Yeah, I think retailers are trying to find ways to expand any way they can. I feel the opposite of what you just said on whether they should self-develop. Obviously, that's a more intricate question based on their corporate structure and finances. But we've seen growth be limited by retailers who will only buy, who won't ground lease, or who
Yeah.
won't do a build to suit because a lot of owners don't want to sell their properties. And I think if you're only looking at one structure, you're limiting the opportunity. Also, leases and rent payments are expensible, right? So there are some benefits operationally to retailers to be tenants, not to own the property. So I don't know. I think a lot of companies are looking at the development process and saying, if we take this in house, look how much money we can save. Look what our properties are worth at the end. But it's not always as easy as they think to
Mhm.
have all of those divisions in house, from sourcing the properties, negotiating them, building them, maintaining them, so forth. So
Yeah.
I don't know. I think there's not one easy answer to that, but I'm not surprised more companies aren't doing it. I think that flexibility is the answer right now. And if retailers like a market and they're profitable and they can expand as a tenant, it's probably the easiest bet. But
Oh,
we'll see.
absolutely.
We'll see.
Yeah.
We'll see.
And
We could,
certainly the retailers are agreeing with you on that point. I just keep asking, and one day somebody's gonna be like, "Oh, we do that," or like, "Absolutely not," and they will lay it out. A lot of the time, what you're saying, like, it's just easier. It's easier to rent, right? It's easier to rent than it is to buy a home. Very similar things,
right, right.
very
And there's
relatable,
Right,
but,
and
like,
I think there's 2 pieces, right? There's the development, so, like, Tractor Supply is looking at self-developing. That doesn't mean that they won't do sale-leasebacks. It doesn't mean they won't hold the real they will hold the real estate after they build it themselves. They're just looking at the development piece
yeah.
in-house. So you have both the, do we buy the land and build, or do we rent something existing or do a build to suit with a developer? And then
Mm,
also, do we maintain the real estate as part of our site, or do we sell it off? So it's really two separate discussions. But I think any way they can expand, they're exploring. And I've heard a lot of variety with development for that exact reason. Sites are hard to find. And if they need to buy the land and build it, and that's the only way they can get into a market, then
mm,
more retailers are considering it just from an optionality standpoint.
yeah. And San Antonio would be one of the few markets where it deserves more consideration, given some of their low permitting costs, their
Mm.
friendliness to development, and other things that they have going for them. They do have some interesting real estate tax laws that are a little bit different than the rest of the country, but I would still say of all of the 6 markets we talk about, San Antonio is the only one that I think that strategy even has a glimmer of hope. So, yeah.
It's such a good point, and I'm glad you brought up those additional elements there because the difficulty in building or not the permitting process, the timelines, the approvals, all of that is such a huge part of this. And the same deal can take 6 years in one market and 9 months in another. Literally that much of a bifurcation in timeline I've heard on the same types of deals in different parts of the country. So understanding the market from that perspective obviously is a huge piece of this puzzle. So you're right. Maybe San Antonio has a unique advantage from that element.
Yes. Even if it's not a total advantage.
Right, right.
Yeah.
And even if it's
Even
not a total hidden gem, but we're still keeping it on the list here because it's
yes.
hidden to some people.
Yeah.
Okay, let's go to our third one, going back to the East Coast, and this is Raleigh, Durham, North Carolina. Now, when I think of Raleigh Durham, I think of all of the massive hospital systems there. I'm not really sure why, but it feels like an incubator for medical research and advanced medical procedures. I'm not exactly sure why I have that view of it, but I know there's a lot of population growth there for some of the sciences. Aside from that element, what is driving your focus on Raleigh Durham?
So their fundamentals are good, first of all. Like that has drawn attention to them for a while. I think what kind of makes them a hidden gem is that their office fundamentals have also looked really good. They've done a good job of building work, live, shop, work, live, play environments, and they're seeing that pay off. And their population is really stable. So, the Sun Belt has seen a lot of incoming population, but they've also seen a fair amount of outgoing population, net positive in general. But places like Raleigh have not seen as many move outs. So even though maybe they haven't seen as many move ins, people there are very happy there, which leads to good habits, good spending, better savings, more money kind of flowing around your more local economy. So, like, those are the things that kind of make Raleigh, Durham a little bit of a hidden gem. Now, its vacancy continues to drop. Rents are up 10.5%
I was
year over
just gonna
year.
say, aren't the rents just crazy, increase year over year, 10%, 10.5%? Isn't that one of the highest in the country?
Yeah. Second, I
Amazing.
believe number one is Manhattan. I don't
I mean,
have it in
that
front of me right now.
feel like would be logical, but if you were to say, "Okay, Manhattan's number 1, what's number 2?" I bet, like, 1 out of 100 people would say, "Oh, Raleigh," right? No.
Oh, yeah, I wouldn't.
So,
No, I would
no,
have
right?
never.
So that
Absolutely not.
is a true hidden gem. That is a surprise. I wonder how sustainable the rent growth is. I mean, that's just an incredible jump year over year.
Yeah.
And do you think that's mainly driven by these new live, work, play communities coming online? Is it a development driver, population, stickiness? You mentioned. What do you think could be leading to that growth?
So this is, I'm going to just get a little nerdy here, and go back to kind of more EA data that helps kind of build this market up. We have life sciences data, we have medical outpatient data, we have data on hospitals that I get to look at when I'm looking at these markets. And because retail is really a companion asset, right? Like, yes, it's an asset in and of its own right, but retail located around other assets that are, even if those other assets aren't doing well, as we've covered before, right? Retail located around any office, even the suffering offices,
Right.
outperforms on rent growth. We've covered that before in an episode. This 10.6% year over year growth is not asking rents either. It's our EA rents. So it's a repeat rent series, which means we are seeing sometimes it's called same store growth, or same space growth, same building growth. For a building, on average, your rents are growing 10.6% year over
Yeah.
year. And that's not mark to market. That is just what we're seeing,
Those are real numbers. Yeah.
Yeah.
That's
So
incredible.
yeah, that's wild to think about when you're thinking the national average is somewhere in the 2 to 3% range,
Right.
depending on how you want to cut it. We're looking at 3 times that about in
That's
Raleigh,
amazing.
but it's population growth,
Mm-hmm.
as you have here, is 2.4% annually, which is higher than the
Right.
U.S. average. All those wallets got to spend somewhere.
There's some investors right now going, shh, I don't want anyone else to know about this, outsized rent growth we're getting here and the returns we're getting. Like, stop talking about Raleigh, because that's really exciting for them or
Yeah.
whoever's investing there. Those are good numbers for sure.
hmm Yeah, and it looks great almost any way you slice it right now. It looks like a great commercial real estate market, positive lifestyle benefits, and great fundamentals.
And it's sticky, right? This is not a vacation place
Mhm.
or transitory population. I think that was one of the more interesting pieces, was that the population growth is sticky and it seems to be a very stable, good quality of life as well. So
Yeah.
all those kind of come together to give you a good long-term solid outlook.
Mhm.
All right, let's move on to Philadelphia. Now, I've had mixed feelings on the city of Philadelphia, but I will tell you, I was there for a big pitch a few weeks ago in downtown, and it
Mhm.
was so vibrant. The city was absolutely bustling, wonderful restaurants, ton of people out, the middle of a work week, midday, and had exceptional energy. I saw no vacancy in the part of the city that I was in,
Mhm.
and it really was very impressive what is going on in I guess certain neighborhoods, or at least where I was. So I think Philadelphia has a mixed impression. A lot of people absolutely love the city, some don't, but there is reason to love it in the hard facts. So tell me by the numbers why we should be paying attention to Philadelphia.
So I've spent a lot of time looking at Philadelphia because when I first started, doing forecasting of these markets, uh, Philadelphia and I did not have a good relationship in terms of forecasting. I would think it was going one way and it would go the other way. Normally I can get the correct direction of a market, you know. You never get the number exactly right, but you can get the direction pretty well. And Philadelphia just would swing me left, right, and center. And that's because it had a lot of this bifurcation going on where all this old retail was kind of getting swept out, but they were still trying to fill it. Population was redistributing into the right areas of Philadelphia. It was experiencing a lot of new build of like multifamily. So the population was going to be in Philadelphia and it was going to be in these great places of Philadelphia, but it just wasn't there yet, which was
Mm,
kind of dampening these statistics.
right.
Uh, and it really has kind of bottomed out. And now we're on the upswing for Philadelphia. The retail space is really in the center of the city and then in neighborhoods. We did a map of the month on Philadelphia. Maybe oh my gosh, it's
Mm,
probably been like a year ago, where we just
okay.
took little hexagons in the very downtown market of Philadelphia. And you'll see two little micro markets a block away from each other. One of them is experiencing negative rental growth, and then the other one is topping out its rental growth. And that's all because of where these multifamily units have been
Right.
put up, and they're just bringing more wallets into those specific areas of Philadelphia that people want to be.
Mm-hmm. And it's funny, just not technically, but that's exactly how I felt on my various trips to Philadelphia for work. It's either, wow, I really don't like this city, to, wow, this is phenomenal. What a fantastic, vibrant area, just a year apart. Right? So I think there is a story of different parts of the city and in different micro markets within. I guess any big city is like that, but it felt more extreme in Philadelphia. And maybe that's smoothing out. It seemed that way, right, when I was last there. And it sounds like the data is suggesting that there's just more consistency across the city, perhaps than there used to be.
Yeah, we're starting to see some of that because all of those spaces are filled now. You know,
Hmm.
the retailers are doing well, move into these spaces because they're doing well and they want to expand or capture the market that they know is going to be there. And then maybe they move out of their old space and that puts that space back on the market for somebody else, for a new retailer to move into and reestablish. Um, and we're starting to see that happen with continued drops in availability and vacancy in Philadelphia as some of these auxiliary spaces are being retaken up
Hmm.
by new retailers, bringing vibrancy outside of even just these central, shiny new
Right.
multifamily kind of constructions and residents in downtown Philadelphia.
I think the last thing I wanted to point out on Philadelphia before we move on was a fact that you had shared with me, and that was that the housing permits, was it 14% up year over year? 16%.
16.
16%.
Yep.
That's really, really high, right?
Yep.
So what's the lag time from the housing permits till we see that in our household formation numbers? Is there a
The,
clear, like a year? I mean, are we looking at this big influx of population, in a set period of time based on the permits?
I think the rule of thumb is 3 years.
Oh, wow. Okay. Longer than I
Um,
thought.
if you're talking start to lease up.
Okay.
Um, now, the there has already been a lot of housing constructed in Philadelphia. So this 16% is jumping off of an already large base from 2023. So like, you know, even more population, even more demand is going there. One of the interesting indicators to look at always is multifamily rents.
Hmm.
And if multifamily rents are going up, we expect more housing to be built. And then when more housing gets built, that does end up relieving some of that pressure, which is very interesting for retail because these new apartments get built and they're actually at like a slightly lower rent than these older
Hmm.
apartments because these older apartments have had
So much
pricing power
growth.
recently.
Right.
And you get a newer apartment, it's 3 years, so they're still shiny new as far as I'm concerned, a 3-year-old
For
apartment.
sure. Yeah.
Anyway, you get this new apartment at a lower cost, which means a better bottom line for your household, which frees up more spending for retail. So, like, this cool trade off between multifamily building and retail is just really interesting. And in Philadelphia, it all seems to be positive. It's a if you build it, they will come story in Philadelphia right now.
Amazing.
And yeah,
So it seems like we have these, leading indicators that there will be more and more population growth, which of course will lead to more foot traffic for
yeah,
the retailers. And I would expect more retail growth, both from the retailer demand side, but then potentially also from supply, especially if this is a mixed use building and there's a retail component to it. I guess the question will be, which outpaces the other, or is it remain in perfect balance, right? Is there more retailer demand as the population increases, or is there more space coming along online as part of these projects, and it takes a bit for the retailers to catch up?
yeah.
I'm assuming it will be the first scenario where more population brings more retailer demand that is unmet, and they're waiting for the supply to be done. I guess we'll have
I
to see.
I agree with you. I think it's the first scenario.
Yeah. So that's good
Building
news.
building is just going to get more and more expensive, even with
Right.
some of the provisions in the big beautiful bill that will help construction. Uh,
Hmm.
I, I it's still so expensive. I can't see
Right.
much new retail being built across the U.S.
Right. Makes sense. All right, let's move on to our next market, and that is Central New Jersey. Now, being in New Jersey, I'm not that surprised by this, but I have a feeling our listeners in other states might be. So I'm gonna have thoughts, but I'm gonna let you tell me what's wonderful about New Jersey as a starting point. Don't
Uh,
sugarcoat it. I mean, just like lay out all the good stuff here.
so I think what's wonderful about New Jersey is that people in New Jersey are very aware of how others perceive New Jersey outside
Yeah,
of
what are
New
you talking
Jersey.
about? It's a good start.
But like central New Jersey, it's still very dense.
Hmm.
Lots of wallets, very little space. Much of the space that has been built in central New Jersey has been um, refurbished or improved in some way. They had right before COVID, there was a lot of investment into parts of New Jersey and their offices, both in the city center and outside of it,
Sure.
which saw a bit of suffering these past
Yes.
3 years. And
Lot of office product for sure.
yeah,
That's been a challenge.
and we're coming out of that now. People are
Mhm.
returning back to the office, and they're returning back to like a much nicer office space than they might have left, even, which is
Right.
wild and interesting to be like, oh yeah, like we were in this office for 1 day a week after COVID or whatever. And so all of those are looking good. Of course, it's closest to New York City, which is the largest retail market, I would maybe in the world. It's certainly a world class market. So that it can pull in population from there or the commuting population coming from New Jersey to New York. They hop off, grab something at a strip center that's accessible, and
Mhm.
pop back on. Uh, the other cool thing, because we have this obsolescence data set, is that central New Jersey has the lowest amount of obsolete retail space in terms of um, percentage wise. All of
I
its
think that's amazing, actually, right? The lowest obsolete retail percentage overall in the
yeah.
country. Do you think that's because it's so difficult to build? It's such a supply constrained area that landlords have spent more upgrading their properties. They've, really put the money in because it's too difficult to just go build somewhere else, that there's demand and retailers are taking second gen space and putting more ti in, like people are just working with this space? Or do you think it's newer product overall? What's leading to the low, I mean, incredibly low obsolescence rate?
The density of wallets to these
Okay.
centers and the inability to build more. And when
Right.
when you
Combination.
have to travel through these dense areas, you want to take care of all of your shopping in one place.
Hmm.
So if you're going to build a new center, you have to lure away people from the habits that they build. I shop at a store that is farther away from my house because I like it better than the store that's close to me. Like we have these preferences and habits, and we're willing to take on additional costs to keep them. So building a new center, it would be incredibly difficult to do in central New Jersey anyway to find the space for that.
Right.
Um, but then you also have to pull those wallets away from their current habits, which is just not going to happen right now. And interestingly enough, central New Jersey, they have the lowest obsolescence rate. They also have a fair amount of large malls,
Many, many.
which, again, we've talked about this before. I think of
Yeah.
malls and I think of the Midwest. That's just where I go to. and you had said, well, New Jersey has a lot. And sure
Quite
enough,
a few.
you're
Yeah.
correct. They have a lot. The obsolescence of their malls is also incredibly low, which keeps the rest of their obsolescence very low. And those malls, again, they service a large population. They're largely goods retailers, whereas your more local retail has your essential retailer, and then it has service oriented retail. And all of that has just been doing incredibly well recently, especially because services are preferred by higher income individuals spend a majority of their income on services compared to goods, when we're not talking large good purchases like cars or other things.
Right.
Um,
I do think that
so
that probably plays into the overall cost of living, right? New Jersey is a very, very high cost of living. So it requires people to be higher earners to live there, which then would make sense that there would be an increased demand for services, to your
mm,
point. So that would fuel the, gosh, there's so many service-based tenants, but everything you
yeah,
can think of, right? Being represented and looking for space. So that likely is part of the drive of the low obsolescence and low vacancy as well.
yeah, absolutely.
So let's go on to our last but not least market, which is really a menagerie of various markets, and that is the NYC boroughs. So Brooklyn, Queens, the Bronx, so forth. I mean, really
Mhm,
part of the city, but not Manhattan proper. Although we already
mhm.
know Manhattan is really in a great place right now. What is driving the growth or making these boroughs, which are very much not hidden, but are hidden gems for investor purposes? What is giving them that designation in your mind?
Yeah, the people that live there are choosing to stay there.
Yep.
It's still a neighborhood. They are kind of commuter markets, which is it brings the wallet out of the house. And once you're out of the house, sometimes it's easier to stop at a retailer and grab what you need instead of ordering it on, Amazon or whatever your other large e-commerce retailer is. So they're going to benefit from the fact that they're having to go out more, but they're still using the amenities of New York City, like the world class amenities of New York City, like
Right.
Broadway and, all the other uh, experiences that New York City has to offer. They're still using those, but they're keeping their food spending closer to home, and that's food and beverage spending out on restaurants. All of that they're keeping closer into their neighborhoods because they formed these habits again post pandemic while they were stuck at home. They learned their neighborhoods, they learned the people around them, and they learned the businesses around them as they started to reopen. And as long as they continue to choose to spend closer to home, these are looking really good and really positive in terms of their success because they boast all of it. They boast all of the things that we want to look for: commuter market, high land values, and uh, large a large population relative to retail square footage.
And how do the rent growth numbers look? I'm sure there's some nuances because we're talking about some pretty large markets, but how do they compare to other parts of the country? Has there been outsized rent growth as well?
Yeah, you're looking at 3.8% year over year.
Nice.
Uh, so that's well above your average of 2-ish%
Mm-hmm.
for the nation. It's no 10% like we mentioned earlier.
Say it's no
But
Raleigh, but fine. Yep.
yeah, but there's a lot more retail in a lot more places in these markets, I guess. Like there are more micro markets across
Right.
the boroughs than I would argue there are across Raleigh in terms
Of
of
course.
servicing the population numbers. Yeah.
Hmm. And I'm sure you could dive in, and I bet EA has done this, to the micro markets and kind of look at your hexagons by neighborhood and really get granular and find some very interesting trends and takeaways within the boroughs. I mean, we're just saying the boroughs, which is so many millions of people. It's so broad. And I think overall they are doing well, but there's a lot more, I would imagine, to that story with these different neighborhoods and layers of markets within the larger market.
Yeah, absolutely. Yeah, always, absolutely, always the case. Always
Yes,
can look more local, and I think that's why there's always an opportunity in retail, is because you have to pick a corner,
right.
and it's either this corner or
The right
what
one.
kitty corner, the corner across from it. What you
Yeah.
have to pick your place, and it matters. It literally matters what side of the street you're on sometimes in terms
Hmm.
of your success rate. So
Yeah.
yeah,
Depending on the
it's just
use, the type of tenant for sure.
yeah, it's so
Interesting.
wild how varied retail is, and also how varied the boroughs are. I would never compare them to each other. I'm glad I
Right.
can talk about all of them generally because I am not a New Yorker and I don't want to get involved in that.
Could really cause a sparring match there if you started picking favorites. So we have no favorites. We
Yes.
just love all of the boroughs equally. No, but good to see that these things that make them good long-term investments are really falling into place. Like you mentioned, the outsized rent growth, that good occupancy numbers, the retailer demand, the stability of the population. Those are all things that we want to see long term. And it does
Mhm.
sound like they're coming together very nicely for the boroughs, our our sixth favorite hidden gem market.
Yeah. Yes.
So let's just kind of recap some things that investors should think about and retailers should think about as we're looking at hidden gem markets. And like we said at the beginning, this is by no means an exhaustive list. It's just an interesting look at some markets or areas that maybe haven't been on the top of the headlines, because often to find opportunity, you have to go outside what everybody else is talking about or doing. So we looked at these markets and we chose them just to kind of recap because they had, in most cases, strong rent growth, very low obsolete retail numbers, low vacancy numbers, and then coupled with a sticky or growing population base, right? And likely limited development in some cases that's constraining supply. So, what we're really talking about is stability and the ability for rent growth to happen over time, which makes it, a win for investors who own in that market.
Mhm.
Anything else from the investor side you think they should be kind of thinking about or looking at as they're looking for or considering these hidden gem markets?
Yeah. So even though some of these markets have a slightly lower occupancy than average, we see good momentum in these markets, which means those spaces that may be available can be marked to market, which is
Hmm,
anywhere
that's
from 10
great.
to 35% above your in place rents, oftentimes in these markets. So those lower occupancy markets we discussed here, we upgraded the expectations of retailer demand, which will drive occupancy up. But that also will buoy rental growth uh, in the interim while you get to mark those available spaces to market. So a lot of those are going to be coming up in the next 1 to 2 years. A lot of those leases signed during COVID are going to start expiring. So markets like this that have increased retailer momentum in terms of desire for space are going to look very good as you're able to, if you're able to turn over some of those leases uh, that were signed during the uncertainty of the years directly post pandemic.
That is such a fantastic point. Mark to market is really powerful. And, so many conversations I have with investors is find me something with below market rent, which is that's what it means, right? When this lease expires, I can mark to market and I get that huge boost. So the fact that this could be a wave coming up from leases expiring is very exciting from the investor perspective.
Yes.
So,
And we should
right.
have clarity within a year in terms of kind of where the market sits more to
Mm-hmm.
know how to mark those to market, as opposed to right now where the retailers have a little bit more bargaining power with that looming threat of tariffs, as we've discussed
Right.
before and anybody else has
Right.
discussed before. And I'll leave it there.
Can you give us a date for market clarity? Because I'd like to just kind of put that on my calendar and circle it. You said a year. I'm like, can we paper that, please?
Sure. Why don't we say July 1st for 2026? We'll
It's
have
really
some
far.
market clarity.
I'm not accepting that. It's too far. It's too far. Okay, fine. Fine. You say that, I'll come up with my own.
Okay.
Um, all kidding aside, yes, definitely a volatile time, but with volatility gives opportunity. So,
Mm,
this is part of the market we're living in, is finding these hidden gems
mhm.
because of the shifts in the market. So it's not all bad for sure. Before we wrap up, let's look at it quickly from the retailer perspective. What do you think retailers should be considering, or what are they looking at when going to a hidden gem market? Is it population growth, number one? What is the biggest factor that you think would drive decisions there?
Yeah, I think if they have a new store format that they're looking at expanding in, a lot of these markets have smaller spaces available that some of these large retailers could expand into
Hmm.
at a slightly lower level of market rent, even though maybe they have more uh, aggressive escalation clauses for these spaces. They can still get in at a lower rent, experiment, and see if some of their new ideas are working in these smaller formats. Uh, so that I think is going to be very valuable. It's going to give them further access to their consumers. And just the more information these retailers get about their consumers, the better and better they are at focusing themselves on the neighborhood and their consumers and growing their consumer base organically and actually providing better services to their consumers that want to use them as a retailer. And then, you know, you have to, right now, if you want to move into a market, you better be thinking about it right now if you're a retailer, because that space will be gone tomorrow.
Right.
Uh, that's just the reality of the market we're in right now. Still a lot of demand from retailers, from all types of retailers, across format, across space levels. Um, so,
I love the angle of growing organically and maybe testing a smaller prototype or dipping your foot into a new area that has strong population fundamentals as well. I think that's, such a good strategy that I'm
mhm.
sure they're employing, but that makes all the sense in the world.
Yeah, absolutely.
All right, Dan, this has been very interesting. I love hearing the thoughts behind the data, and it's always fun exploring new markets and new opportunities for our clients. So thank you so much for sharing all of that with us. Great to see you.
Yeah, you too. Thanks.
To everyone listening, that was this month's episode of Commercial Real Estate Now in partnership with CBRE Econometric Advisors. We're so happy you tuned in, and we will see you again very soon. Have a great day, everyone.